Hello and welcome to the show. I'm Kim Parley. Great to have you with us. The last time my guest came on Money Talk, the Dow had just blown past 19,000 for the first time ever. Fast forward to today, and the Dow is now sitting at 20,775, again, near another all-time high. So can the markets just keep moving higher? Joining me is Damian Fernandes. He is portfolio manager for the TD Balanced Growth Fund. Joins me here in the studio. Nice to see you. I think I'm going to just start, if I could, because you brought in a chart, and I think this chart really is a great illustration of what you think is going on right now. So let's pull up. This is the S&P 500 earnings per share growth, and it's a pretty spectacular chart.
I think so. So the main thing about that chart is that, look what's happened in those last two bars. Earnings have grown from being negative for about 4 quarters. In Q3 2016, they actually inflected and they were positive for the first time. And then this quarter, we're looking at high single digits earnings growth. So revenues are growing close to 5%. Earnings are growing close to 7.5%, 7.7%. 2 quarters of earnings growth, regardless of Trump or anything political. This is Trump took office in Jan. These earnings were in the books.
Yeah.
Right? And like a 7.5% earnings growth is a solid number. So I guess my point about this is that Trump is the icing on the cake, but people come from the cake.
I think that depends on your perspective, but from the earnings case.
From the earnings standpoint, from what's better for markets, from his positive policies, but people come from the cake. And the cake is strong economic momentum, it's accelerating earnings growth, it's easy liquidity conditions, and it's surging sentiment, whether it's, small business sentiment, CEO confidence, U.S. consumer confidence. All these sentiment measures are really positively disposed. They feel like the environment's a lot better.
It was already happening.
It was already happening.
Let me ask you, though, because I know one thing that we don't talk a lot about in the show is share buybacks. And of course, if this is an earnings per share calculation, if there's fewer shares out there, is that part of it? But I'm also going to disagree with myself on the same question by saying they've been doing that for a while too, haven't they?
Yes. So share buybacks have actually, over the last few years, because of the collapse in commodity prices and so on, you've had share issuance. So share buybacks haven't been a big contributor. This growth is really being driven by top line and some margin expansion. As we go further on, what you'll see is that as companies are more flush with cash, they will start buying back shares. But right now, the last 2 quarters, it's really like a core earnings growth number.
Let me ask you, when you take a look at the sectors right now in terms of what's attractive, I mean, what are you seeing? What are you seeing within them?
Well, if you believe that the market or the economy is on a cyclical upswing, that should bias you to cyclical sectors. We particularly like financials, which benefit from a few things. Which benefit from, if there's more activity, there's more loans. If there's more activity, rates are normally moving higher. The U.S. 10-year has gone from 1.8 to 2.4. So net interest margins are higher for financials. And also, you have less regulation, and they benefit from taxes, like potential policy improvements that will actually help their bottom line. So we like financials, we like secular winners in tech.
Well, I think the example of stocks you guys like right now are both, one's financial, one is tech. So let's talk about them. Microsoft is one you like.
Sure. Microsoft just reported, and we've talked about Microsoft before on the show, and people still have this misnomer of sleepy old Microsoft. But Microsoft this year, Azure is its cloud-based business. So Azure revenues were $14 billion. This was up 140% year on year. They're targeting this business to be $20 billion. So by 2018. So in a few years, their cloud-based business, which is where all the growth is in tech, is going to be 25% of the company. So Microsoft is like one of these pure plays on cloud-based growth, but it also has one of the greatest shareholder repurchase programs. It pays a 2.4% dividend that's growing 15% a year. So it's flush with cash. So we see it as being a winner in the secular, winner in tech.
Let me ask you about JP Morgan. I'm going to ask the folks in the control room to bring up a 10-year on JP Morgan, because I just want to get a long-term perspective on this. But you like JP Morgan right now, too. We
like JP Morgan because it is a high-quality bank. It participates in all factions of where growth is coming from, whether it's loan growth or capital market activity or credit card spend. JP Morgan is a leader in all those spaces. It's out of the large cap banks in the U.S., it's the second most sensitive to improvements in net interest margin. So if you believe rates are moving higher, JP Morgan actually benefits disproportionately. Also, and people forget this, it is a great shareholder return vehicle. Last year, they returned $17.5 billion. That's 5.5% of the company right now. This is just it's split between share repurchases and dividends. We see continued dividend increases, and come June, when they have the CCAR, when they ask to see how much they can repurchase shares, we can see continued gains in those too.
I want to just, because I want to ask you about the question about PE ratios and just how expensive things are right now. If we can bring up a 10-year of the S&P 500, the JP Morgan 10-year chart was pretty, I mean, it had lots of dips, but straight up on
more
the right.
recently.
Microsoft, same. I mean, if you take a look at things even like the Schiller price-earnings ratio, and here's the S&P 500 again at, you know, all-time highs. There's a 10-year chart on it. I mean, or close to all-time highs. Is it not expensive?
Well, I love talking about the Schiller PE ratio, because right now the Schiller PE ratio is about 17.5.
Yeah.
The last time it was here was June 2004. June 2006.
Okay.
So people forget this, right? 2004. Sorry, I'm getting my numbers mixed up. So 2005, 2006, 2007 were all great years. The market was up close to 40% in that time period. It was up,
even though it was high.
It was high. Like my point is that what arrested the market decline was the 2008 recession. But when you're not supposed to be invested in stocks is when there's a recession. We just don't see that in the cards right now.
Fantastic insight, Damian. Thanks so much.
Sure.
Damian Fernandes, Portfolio Manager of TD Balanced Growth Fund, joining me in studio.